Good afternoon, everyone. Ron Chapman here with Executive Home Realty here out of Maryland. We are here on Beyond the Keys podcast. It is Thursday, February 26, 2026. I like to do what's called a Lender Thursday. My guest here today, John Carlson from Penn Mortgage. When we talk about the legs of purchasing home, whether the financing portion is very important. I've known John for some time, and full disclosure, we're both married to two amazing ladies, our better halves, who are sisters. So I've known John not only professionally, but as family. And I can tell you, he works Monday through Sunday. I said Monday through Sunday. We'll get to that when we talk about lending, having somebody you can reach out to. John, for those of you who do not know Penn Mortgage, what do you do and who are you in Westchester, PA?
And number one, thanks for having me on. Looking forward to our conversation today. Penn Mortgage, we're an independent mortgage broker out of Westchester, Pennsylvania. We're licensed in Pennsylvania, Maryland, Delaware, New Jersey, and Florida. So we work with dozens of different lending institutions that offer all the different types of residential and commercial financing, and really work with buyers and companies to help kind of strategize their best way to win a contract.
For Penn what separates you when we talk about mortgage brokers from a
Yep.
retail bank? What is the difference?
If you're working with a retail bank, basically kind of look at it like you have one menu to choose from. They get one set of daily rate sheets that they can pull off of. With us, we work with dozens of different lenders. So we have, every different type of program that's out there that's available for conventional financing or FHA, VA, USDA, et cetera. And every bank has a niche. Certain banks are good at certain programs and some others. We truly shop the market to find the best terms for our clients.
When it comes to the residential side and home buyers themselves, what should a buyer have ready to go before they even apply with a mortgage?
So there's a few basic documents that every bank or broker is going to ask for. So to help qualify you for your purchase. So there's going to be some income and asset documentation like your W-2s, your pay stubs, probably 2 months bank statements. They'll want to see your ID, and they'll probably want to pull a credit report.
I wanted to pull that thread just a little bit because one of the things I hear sometimes from buyers when they come to me is they tell me, well, I've already been pre-approved,
Yep.
and they're afraid to have another qualification done because I always like to say, well, let's see if I can get you a better deal. And so, they get that I'm already been pre-approved. And a lot of times there's a confusion between pre-approval and pre-qualification. I'll let you discuss that. But how do you ease that buyer into, hey, let's see if we can get you something competitive? Because I don't want you to just stop at one shop.
Yep. So that's the tough part is because if you ever go online and ChatGPT or Google or anything, everybody says if you have your credit pulled, it's going to hurt your credit score. And that's not really the case. It depends on the how extreme the pulls are. So generally, a buyer should be able to have the due diligence to shop around for their best terms. So generally, if you're going to shop around for a mortgage and you're going to get your credit pulled, it's best to kind of have those pulls done in a 2 week period because they kind of lump those together. If you have 3 or 4 credit pulls over a 2 3 week period, it's going to really count as one pull. Where the problem comes into play is the habitual pulling of credit. So the way that credit scores are calculated is they take a bunch of different factors. One of which is being, how many pulls you have. And when they pull these millions of credit reports together, they look for common characteristics of people that went into foreclosure. And one of those characteristics is they were trying to get help from everyone. So they would call and get turned down, call somebody else and get turned down, call and just keep that cycle going. And the more and more you do that, that's when you can have an exponential drop in your credit score. Is repetitive pulling over weeks and months.
What are some of the biggest mistakes you see first-time home buyers make?
I think the biggest thing is kind of putting the cart before the horse. I think before you start, shopping, you should really kind of understand where your budget is, what you're going to qualify for, what your payment's going to look like. Because it's tough when you start doing the window shopping early and you fall in love with something and then maybe it doesn't fit, then it can be financially and emotionally distressful. So I think the biggest thing is to see where you're going to be the most comfortable first and then start the search.
Ha- On our side as realtors, it's very pertinent to make sure we explain all the fees that are going into that final note, right? Start doing the window shopping, then you talk about, property taxes, really having that sheet provided to them of here's what it's going to cost for you to be in this house on a monthly basis is important.
The way that we kind of structure that is in the very beginning, we collect those documents, find where you're going to be, the buyer's going to be comfortable. It's funny, there's two different numbers. There's a number that you can get pre-approved for, and then there's a number where you're going to be the most comfortable. And that pre-approval number is usually, a good amount higher. But that doesn't necessarily mean you're going to be the most comfortable. So once we kind of have that number, have that range, you and I work together with the client and find that range. And then as they start sending properties out to you that they want to go see, then they also come over to me. We put together a spreadsheet for all of our clients. So if you're going to go see 3 or 4 houses that weekend, we have a spreadsheet done with their different financing options that we've discussed, whether it's different types of loans, different down payments. So when they go into that house on Saturday and Sunday, they're not guessing. They're not saying, "Hey, I want, can we afford this? What's it going to look like?" They've already have all the numbers in front of them, so they can make a decision not based upon emotion, but upon fact.
We teased earlier pre-qualification and pre-approval and the difference between the two because I see that. And, as realtors, we have to have that conversation when somebody comes and says, "Oh, I've been, pre-approved or pre-qualified," and understanding what the difference is because when they hear that, a lot of times they think it's one thing. So can
Correct.
you
And
touch on that?
absolutely. But yeah, a lot of times people think it's the same thing. It's not. So a pre-qualification is a verbal conversation. So somebody calls me up and says, "John, I'm not ready for the process. I want to be pre-qualified." It's a verbal conversation. I make X amount of dollars per year. My credit score is here. I have this much in assets, and this is my monthly debt. What am I pre-qualified for? And we can kind of back into that number. So it's kind of a guesstimate. A pre-approval is the full rundown. So we review, your income documentation, your asset documentation, pull the credit report, and basically it's your green light to go ahead and put in an offer for a house. COVID really changed. I know nobody likes to talk about COVID anymore, but COVID really changed the world with this. Before COVID, people could go see a house, whatever. They'd get pre-qualified, they'd go see a house and figure it out later. But COVID happened. It was an excuse to not let people during that. We don't want anybody coming to our house unless we know they can buy it. And then it kind of stuck. So if you're just kind of trying to figure out where you should look, pre-qualification is going to be okay. But if you want to start seeing houses and you want to potentially put in an offer, you need to be pre-approved.
When we're looking at that pre-approval, when they're coming to you with the documents for the home buyers today, what is the credit score that they need to really be at in order to be competitive and to even be approved?
So there's a whole different range, and depending on the product and whether or not if you're a first time home buyer. So if you want your top tier terms for conventional FHA, VA, et cetera, you're going to want to be 720, 740 or above. That's going to be your top tier rates and terms for number one, the interest rate, but also for PMI as well for private mortgage insurance if you're putting down less than 20%. Once you kind of fall below a 680 credit score, then the cycle kind of flips where conventional might be your most competitive terms to where FHA might become your best competitive terms. How low can we go? Conventional, we can obtain financing down to a 620 credit score. For FHA and VA, some say 580, and some, if you're talking just to a retail bank, they might say we cut off at 580, where we have, as a broker, we've got lenders that'll go down to 500s. So there's going to be some caveats that go along with that. You might have to put a little bit more down. You might have to have some reserves, but we have that full range. So I would say don't let your score where it is now disqualify you. Don't disqualify yourself. Still call, still have the conversation. We can show you where your score is. And then we also have credit tools where we can optimize your score. So we can look at somebody's credit right now and say, "Hey, your credit score is here, but if you do A, B, and C, we can get your score to here." And kind of help. That's part of our job, is to help find the most optimal range or terms or products. So I think it's important to have that credit conversation early. Don't put it off until the last minute.
You hit on a key point, which I think is paramount, but it would be easy for you to just say, "Do you meet this credit score?" You meet it, and then you try to find the package that works best for them and gives them the best deal. But what about those people who don't have that credit score and who aren't at that point yet? You hit on one thing that I think is great for trusted partners is that they will work with those individuals. They don't just dump them to the side. They work with those individuals to tell them, "Here's what we need to do to get you to that point." And we don't leave
Yep.
you to the side, but we get you there. We touch base with you, maybe 30, 60, 90 days, see where you're at. And then finally, when you're at that point, we can work with you there. So I think that's really important. Penn Street does a great job of that, of making sure that, you work with individuals if they don't meet that criteria on how to get there.
We have people that sometimes they're ready to go out and buy a house on day one. And sometimes we have plans where say, "Hey, we need to do this over the next 90 days or 6 months." And we just set realistic timelines and follow up on, "Hey, this is what we need to do now. And then let's check back in at this date and get us there." And honestly, sometimes even if you have a score that you don't want to have, we can still, get it going on day one.
How can someone improve their buying power before house hunting? And we know we talked about the pre-approvals, but what are some
Yep.
other things to help really improve that buying power during that home search process?
Yep. So paying down revolving debt, not making big purchases, before getting ready to go into that market. We can look at what they call temporary interest rate buy downs. There are some different things to do. One thing I would say with that is if I have a lot of people that, I'll have a conversation with and they'll say, John, you know, I've got credit card debt. I got to pay it down. We're not ready to pull the credit, start that process yet because I got to do this first. And I understand that and it makes complete sense to me. But one of the biggest things that I like to say is, hey, let us help you with that. Because if we pull the credit score now and we can see, hey, John, I have, $15,000 worth of debt. I've got about $7,000 that I can use to pay down that debt. We don't want to just make a guess as to where the best place is. Again, using our credit score optimizer that we have with our credit company, I can say, hey, if we've got 7 grand, put four here, put two here, put one here, and that's going to give you the best score. And then we can come back to it.
Moving to the specialized programs now, we're talking VA, FHA, USDA. What loan programs are you seeing most often right now from the Penn Street perspective?
I would say number one is it always seems to be conventional. That's the number one choice for most buyers. The number two product that we're doing, which is I think amazing, is the VA product, and then I would say FHA and then USDA. So conventional, then the three government products, VA, FHA, and USDA. USDA is by far the least, just because there's a few more requirements. But that's kind of, and then we're also seeing some what they call non-QM products, which is a little bit more outside the box. So people who are self-employed maybe don't show their income as strong, or want to buy a property in an LLC, or want to qualify based on the property's rental income, not their qualification. So there's some other stuff that's out there too.
We touched about the VA loan. And John, as you know, I'm a veteran. That's one of the close things to my heart when working with buyers. I come across those families who are either relocating or they're retiring and they're saying, hey, we want to use our VA loan. John, for you, from perspective with regards to VA, what are some of the main advantages you see for those maybe younger or older families using the VA? And what are
Yep.
some of the misconceptions that are out there?
So number one, I think the VA mortgage product is the best loan product out there, as it should be. Our veterans deserve these types of benefits for what they sacrifice. So, some of the features are you can get in with a 0% down payment. They have the lowest rates that are out there in the marketplace. They are a little bit easier in some underwriting guidelines than conventional or FHA. And I'm not sure if I mentioned yet, but there's no PMI even with that 100%
Yes.
financing. Many agents kind of just think that the conventional loan is the only and best way to go. That sometimes if you go with an FHA loan, there are tougher appraisal conditions, or maybe they're not as qualified that they don't have as good of a credit score. That's not the case with VA. So it's funny. Whenever I have a client that's putting in an offer, I always call the listing agent when the offer goes in, to walk through the work that we did, how we vetted the client, how they're qualified, letting them know how we're going to communicate throughout the process, and what communication they're going to get throughout the process, and the work that we've done to make sure that this client is qualified. And so if it's a VA loan, we need to debunk these misconceptions about them not being as strong credit wise, or that they're going to have appraisal problems. So we'll have that conversation with the listing agent. So number one, a lot of times I'll say, hey, listen, I have a conventional buyer that happens to qualify for VA. And it would be silly for them not to take this product because it is by far the best terms that are out there for them. And then there's a lot of concerns about the appraisal, and I'll mention that, hey, with these VA loans, there's something that's called the Tidewater provision, that basically says if there's any issues with the appraisal, if they're having trouble with value or anything else, before they even submit the report, they have to come back to us, and where I can have a conversation with the agents about, hey, are we missing something here? Is there something that we should be coming back to? The VA wants to be a program for as many veterans as possible that qualify, so they do try to work and get it done for the veteran.
So when we talk about interest rates,
Yep.
when we have buyers, and I've seen this sometimes, the buyers will look and they'll say, oh, I heard Jerome Powell is lowering the rate. And then they look at the housing interest rate and they see that it hasn't moved. How are mortgage rates determined and what actually causes them to move?
Mortgage rates follow mortgage-backed securities and the 10-year Treasury, so they kind of follow that market. So depending, and that market is really driven by a lot of economic factors such as inflation, Fed policy, what's going on there, jobs reports. Those really drive it. So where there's a lot of misconception on that is exactly what you said, is that every month or whenever the Fed comes out and they said the Fed cut rates by 25 basis points today, I'll get 12 phone calls the next day saying, hey, my rates should be a 1/4% better. But a lot of times, believe it or not, it's when that Fed cut happens, we see mortgage rates actually tick up a little bit. So they're not directly correlated. Where you see the Fed funds rate, when you see that the Fed cut rates, that is in direct correlation with your short term. So like if you have a home equity line of credit, if you see rates go down by 25 basis points, your HELOC is going to go down by 25 basis points. Your credit card rate should go down. So that's where it's not always a direct correlation. It can cause a lot of market confusion.
Should buyers try to time the market? This is a rhetorical question, but from your perspective, it's great when people hear it from the lenders themselves.
I don't think it's possible to time the market, especially with as volatile as everything has been. I mean, if I were to look back at the past 5 years, if you tried to time the market, you probably had the worst experience out there. Rates were so low in 2020 through 2022 because of a global pandemic, and then they came back. They got higher, and a lot of people started sitting on the sidelines, saying, "Well, I'm going to wait for them, to go down," and they just kept going up and up and up and up, and before you know it, we were in the high sevens. Problem with that as well is the market, the real estate market. So from your side, you've probably, you know everything that's going on. Values keep increasing. So it really kind of strangled people. So not only were rates going up, but prices were going up. We've also seen the same things now where we're starting to have a more positive outlook about interest rates and that they're coming back down. But if you continue to wait for that right interest rate, you could miss so many opportunities, and house prices are continuing to increase along the way. So what I say is don't focus on the rate, focus on affordability, right? The rate shouldn't be your number one decision. It's, can I afford this? Am I going to be comfortable with it? I've heard people say this, and I don't like this term. I like, marry the house and date the rate. That rate, I can't guarantee what rates are going to do. Nor nobody can guarantee what rates are going to do. So I would say, hey, listen, if you can afford it, and this is what you want to do, and this is going to be a good financial decision for you and your family, then do it, right? And then if and when rates go down, we can refinance and take care of it then.
With regards to the rate, and we've got what is known as rate lock. When should buyers consider a rate lock?
A rate lock is when it's a great term, you lock in your interest rate, meaning if the market turns and rates go back up, you're protected. Okay. So you really can't lock in until you're under agreement of sale for a purchase. And important things about that is your rate lock is determined by how long you're locking it. So there are 30-day locks, 45-day locks, 60-day locks. So the longer the lock, the more risk the lender, the higher the pricing is on the loan itself. So once you're under agreement, we'll have our introductory conversation about where rates are, where the market is, what they expect. This is what it looks like if we lock. This is what it looks like if we float. Floating meaning is just not locking it at that time, and try and put a strategy together from there. One thing that's also important, if you're dealing with a retail bank or a broker, some banks and brokers, not all banks will allow you to what they call renegotiate or float down. Okay, so it's important to have that conversation with your lender first before you do lock. So like I said, we deal with dozens of banks. I probably, of those banks, six or seven of them allow what's called a rate renegotiation or float down. So if you lock in your rate, you've created a ceiling. Right. And then, so if rates get worse, you're protected. But if rates continue to go down, and as you get closer to settlement, if the market's improved, they don't want to lose your business. So they will renegotiate down closer to the actual market at the time.
What creative financing strategies should buyers know about from your perspective today?
With the positive outlook on the market moving forward, a lot of people are looking at temporary interest rate buy downs. So where you can buy down your interest rate for a few years to save some money. People are looking at adjustable rate mortgages. They're not as great as they used to be, but it's still an option that's out there. Then we're also seeing sellers concessions depending on your market and where you are, where sellers are paying a portion of your closing costs or helping with that temporary buy down. And then a big market that we're seeing, and a lot of strategies that we talk about, is people that are looking to buy and sell. Buying and selling at the same time is not fun. Most people don't want to settle at the same time. A lot of people want to get into a new house first and then sell their current house. So there's a few strategies that we work with people there. That's either through bridge financing or doing a recast where you may put less down up front. And then once you sell your house, you've got this whole bucket of money that you want to put in. Not all banks allow you to do it. So it's important to make sure you're going with the right bank for that. But then you can dump a sum of funds in and then re-amortize your loan to get a newer, lower monthly payment moving forward.
Penn Street Mortgage does more than just residential. It's also commercial as well. And there's a
Yep.
market for that. What type of properties from the commercial side does Penn Street finance?
When I say commercial in general, like people say, like, well, what fits in there? I'm saying pretty much anything that isn't residential will fit into that commercial bucket. But we do, mixed use properties, office space, restaurants, hotels, multifamilies, all kind of fall into that bucket of commercial financing. As a small business financing, we do owner occupied buildings. All those different kind of things fall into that bucket.
What's the difference in qualifications for a commercial loan versus the residential?
It's night and day. So for the most part, for residential, they're qualifying your income, your assets, your credit, and your ability to make that payment. On a commercial loan, it's more so the property itself and the income it's going to produce. So they want to make sure that the income that's coming in is going to be able to support the payment of the property moving forward.
If someone owns a small business and wants to buy their own building, Where do they start with you?
I would say the biggest thing is kind of pulling all your documentation together. So getting your financials for, from the business, your profit and loss, your balance sheet. They're probably going to want to see 2 or 3 years worth of taxes, a real estate owned schedule. So kind of pulling all that together and everything together up front is important on the commercial side. It's a very different underwriting process than residential. So, when you look at residential financing, we're all following Fannie Mae or Freddie Mac for conventional, or FHA or USDA and the VA's guidelines. So it's black and white, right? You have to have A, B, and C for this to work. With the commercial financing, banks are lending their own money, right? So they're comfortable with their appetite. So it's very good to have all that together up front, so we can talk to all the different banks, have those initial conversations to find who has an appetite for this type of property. Because on the commercial side, when you talk to different banks, somebody may have had great experiences. So say someone's buying an office building. Somebody's had great experience with office buildings in the past. Another bank, got burnt. So what do they say? We don't want to do this, or their rates are higher. So it's important to kind of have all your ducks in a row. Let us shop it, find the best fit, to find you the bank that's going to have the best want for that product.
What programs do you offer for investors for mixed use and multi use properties?
I go back to COVID. I'm sorry for doing it, but during COVID, or after COVID, as rates were going up, the clean easy stuff was conventional loans, everything. It was hard to bring in volume, just because there was so much competition and so many people were paying cash. So a product came out of that. It's called the DSCR, or debt service coverage ratio loan. And this kind of came in where it's kind of a commercial mindset, but also can be used for mixed use and residential properties as well, where they're looking at the property's rental income and ability to pay the mortgage, basically as a means for qualifying. So again, if you're like have a 1-to-1 ratio, so if your mortgage is $2,000 a month and the rent that's coming in is $2,000 a month, that's a 1-to-1. Great, that's good. They'll do the loan. We don't need to review your tax returns. We don't need to review pay stubs. And the other great thing that a lot of investors really like about this is you can own it in an LLC. Whereas if you're looking for conventional, you got to go. You have to own it personally. So it opens the doors to a lot of investors that are out there as well.
What is the mortgage broker and why does it benefit the buyer?
I think the quickest one liner that I could say with that is, if you're a banker, right, you work for the bank, you're representing the bank. If you're a broker, you're representing the client and working to find the best terms for the client that's out there. So having the ability to, depending on their timeline, depending on their goals with their current house, depending on what first time home buyer programs are out there, we can search the market and be an advocate to find the best terms that are out there for you.
And typically, how many lenders do you work with there at Penn Street Mortgage?
So I would say that we can pull rates from everybody. We're probably signed up with 15 different banks, but I would say the majority of our business goes to 4 or 5 of them, just because they are the fastest, the strongest rate and term. But sometimes you have some different scenarios out there. We'll have to go to some other ones. So I would say signed up with 15, really work with 5 the most.
What kind of communication can customers expect, whether it be on the residential or commercial side, from Penn Street Mortgage?
Yeah, I think, with that is teamwork, right? You and I have worked together, and as you can say, neither of us work 9 to 5, right? Our clients are buying houses on nights and weekends. And so they can expect clear and concise communication from us, from the introductory call throughout their pre-approval process to the fact when we're ready to start putting in an offer. You and I and clients working together, strategizing the purchase, the offer, clear and concise communication throughout the process. Once the offer is accepted, we have a conversation about here's what's going to happen next. Here's what we have to plan for the next, 3 to 5 weeks. I'm always going to be, my client's primary point of contact. We have other people that you'll work with as well, or our team as well. But it's clear, constant communication, and as well as both agents we have to communicate with. Both agents every Friday will get a weekly update on how the progress is moving along, where we are, what we need, because we want to keep everybody happy. It can be a stressful process going through the mortgage system, and we don't like surprises. So everybody kind of knows what to expect throughout the process.
Quick fire, 3 lightning questions I always ask next. What's one thing buyers should stop worrying about today?
Timing the market. I think, right. Work on affordability, work on what your budget's going to be, and don't. We can't guarantee where rates are going to be today versus tomorrow. It's kind of been a roller coaster.
What do they need to start doing today?
I would say the biggest things they can do is have the conversation with a lender, even if they don't think they're going to buy for 6 to 12 months. Let's talk about credit. Let's talk about your qualifications and get you as prepared as possible.
How do people reach out to you at Penn Street Mortgage? What's the best way to get a hold of you? Where do they get started?
Really, whatever works best for you. So if you want to email, if you want to text, if you want to call, We use our cell phone numbers. Easiest way to get a hold of us. You can also go to our website, which is www.pennstreetmortgage.com. You can learn about the team, and you can even apply with all the loan officers on the page.
John, I appreciate you being here today. Don't just stop at one rate that's out there. There could be better rates out there to be had if you did that footwork and due diligence. John Carlson, Penn Street Mortgage, thank you for being here today on Lender Thursday, Beyond the Keys.